Hello, what's up traders? It's Clarkson Trades, the habit trader. In today's video, I'm going to be explaining some of the terms we use in Forex trading. So if you are new to my channel, I'll like you to subscribe, like this video and share your thoughts on the comment section. The very first term I'm going to be explaining is buy, long, or bullish. Now, don't forget that Forex involves buying and selling of currency pairs, meaning that you should expect buyers and sellers in the market. Now, you get to buy a currency pair when the base currency will appreciate in price against the code currency. What I mean is, if you are trading a pair like Euro USD, if you click the buy button, it means that Euro, which is the base currency, will increase in price against USD, that's the United States dollars, which is the code currency. So buying simply means that you are anticipating an increase in price of a particular currency against the other. Or if you are buying an asset, it means that you are anticipating an increase in price of that particular asset. I just want to make it very simple and understandable. Now, if you see a market condition or you open your Forex chart and you see the market going up, it means that they are buyers in that market or they are bulls in that market. So you can either call it buy or long or bullish. So buy means you are taking a long position and you are exposed to a potential loss if the price falls or goes against you, which is against your original direction. So I'm going to be showing us a practical example on the chart. Okay, this is the Great British Pound against Japanese Yen. Now look at the direction of this market. It's going up. It means that what? It means that buyers are present in this market at this particular time. And for me to make money in this market, I also need to be a buyer. So if I want to trade this pair, which is a Great British Pound against the Japanese Yen, for me to make money, I need to also be a buyer. So I'll be looking for more buying opportunities. Now, how do I know that there are buyers present in this market? Because one, as a beginner, just know that the direction of the market, where is it going to? It's going up, it's appreciating, meaning that Great British Pound is appreciating in respect to Japanese yen. So the direction of the market tells you a lot if there are buyers in that market or there are sellers in that market. So clearly, this is a bullish market because we see buyers or we see longs or bulls in this market pushing prices up. So if you want to be a trader in this type of market, for you to make money, you need to also be a buyer and you need to look for the best possible place for you to place your buy trades. So I just want to keep it very simple. Buying means that you are anticipating an increase in price of a particular currency or an asset. For example, if I want to buy, let's say I buy somewhere here. Now I'm anticipating that the market is going to push up higher. So buying this particular currency pair means that I'm anticipating a future push in price up. Simple as that. So this is buying. But what if the market ends up selling rather than buying? What if the market ends up going against my direction? That's where I'm going to take a loss, a potential loss. So buying simply means that there are buyers in the market, they are bullish, the trend is bullish, and the we see the market direction going up, anticipating an increase or a future increase in a particular asset or a particular currency pair against the order. So the next term I'm going to be explaining is sell or short or bearish. You sell a particular asset anticipating that the price of that asset will depreciate or will fall or will reduce. For example, if you are selling a currency pair like Euro USD, it means that you are anticipating a fall in that price of a particular currency. For example, if you click a sell button on Euro USD, it means that you are anticipating that Euro is going to depreciate in price against United States dollars. It's simple as that. Now, how do you know that there are bears or there are sellers present in the market? It's very simple. You see the market going down, right? It means that bears are in the market. There are sellers in the market at that particular time. So let me show us a practical example of what I'm talking about. All right, now this is Japanese yen, Great British pound against Japanese yen. Now, first of all, we had buyers in this market pushing prices up. Then suddenly what happens? Sellers took over this market and they are now pushing prices down. So currently, it means that Japanese Great British pound is depreciating against Japanese yen. In other words, Japanese yen is appreciating, because if one currency is depreciating, it means that the other currency is appreciating. Since in Forex, the buying and selling is simultaneous. So if Great British pound is currently depreciating in price, it means that Japanese yen is appreciating. It's very simple and straightforward. Don't make it difficult to understand. If the first one is depreciating, it means that the second is appreciating. So selling this particular currency pair, it means that I'm anticipating a further decrease in the price of Great British pound against Japanese yen. And how do I know that there are sellers in the market at this moment? I see prices going down. Once you start seeing prices going down, it means that there are sellers in the market at this time. For example, let's look at this market condition. All right, now look at this. Now, when you see the market going down like this, what do? You look for selling opportunities, because there are sellers in the market or there are bears in the market at this time, because you see market sellers pushing prices down, right? So it's simple as that. Now, what if you sell and the market ends up buying? You are exposed to a potential loss because the market is going against your direction. So it's easy as that. Selling a particular currency pair means that you are anticipating a future or a fall in price of a the base currency against the quote currency. The next thing I want us to look at is types of orders in the Forex market. And the very first type of orders we are going to talk about is instant market execution, which includes the buy order and the sell order. The next thing I want us to look at is types of orders. And firstly, I want us to start with instant market execution. Now, if you want to place a trade, there are two buttons you see. We have the sell button and the buy button under instant market execution. Now, if you click the buy button, it means that you are telling your broker that take me in on the current market price. For example, you see the market going up, right? And let's say you click the buy button around here to buy this particular currency pair. Now, you are telling your broker to take you in at this current market price. So that's instant execution. take me in on the current market price. So you are instantly entering the market at that market price. You are entering a long or a buy position. Same thing goes for a sell. If you are clicking a sell button, it means that you are telling your broker that what, take me in at this particular price. Open a trade now instantly. Take me in at this particular price. So that's instant execution. So there's so many ways where you can on how you can place a trade. You can either place it through market execution, which is instant market execution, either by clicking the buy or the sell button, or you can place pending orders. Now, this instant market execution is telling your broker that take me in at this current market price. So that is that for instant market execution. Secondly, I want us to look at pending orders. Pending orders. Now, the first pending order we'll look at is the sell stop. Now, the sell stop is actually telling your broker an order that allows you to sell a particular currency below the current market price. I'll take it again. Sell stop is a particular order that allows you to sell a currency pair at a specified price below the current market price. So, for example, if the market is trending downward, means there are bears in that market, the market is selling. Now, you place a sell stop order. You can place it somewhere around here. Let's say this is a current price, 1.0237. This is a current market price. Now, you place an order around here that if the market gets to this place, to this price, to this particular price, let's say this price is 1.0138. Now you place this sell stop order just below the current market price. So if the market should get to this price, it's going to take you in instantly. It's going to activate the order. So you are going to be in a sell position. It's going to trigger the order. So that sell stop for you. You place your order just below the market price. So if the market should get down to that your price, it's going to take you in and a sell trade is going to be open. That's for a sell stop. Now, a buy stop is directly opposite to a sell stop. A buy stop is you placing a trade just above your current market price. So, for example, the market is bullish, means there are bulls in the market. The market is long, right? Now, you want to enter this market, but you don't want to enter at this price here. Let's say this current price is 1.2871. You don't want to get in at this current market price. So what you do is that you place a pending order somewhere around here at a particular price. It can be 1.2941. We are just estimating. Now you place a pending order around this price that if the market should get to this level, it's going to trigger this order and a buy trade is going to be open. So that's for buy stop. Now for sell limit. For sell limit, a sell limit order is a type of pending order that allows you sell a currency pair at a specified price above the current market price. For example, the market is trending downward. The market is in a downtrend, right? And you want to get into this market, but you don't want to enter at this current market price, right? You place a pending order above this price. That's a sell limit order. above this price. Now, if the market should go up or retrace and trigger you in, a sell position is going to be open, right? So you don't want to get into the market at the current market price, but you place a pending order just above the current market price. So let's say, for example, this was the current market price here, but you place your pending order somewhere around here. So if the market should retrace up, it's going to activate or trigger this your sell limit order, and a sell trade is going to be open. A sell trade is going to be open. Same thing goes for a buy limit. A buy limit is a particular order, a particular pending order that allows you buy a currency pair below your current market price. So if the market, let's say for example, the market is trending and you want to place a buy limit order, or let's say you want to get into the market, but you don't want to get into the market at this current market price. So what you do is that you place a pending order at a price somewhere around here, a pending order below the current market price. So this is the current market price, but you place a pending buy limit order here, a buy limit order, a pending order. Now, if the market should retrace, it's going to trigger this your order before what going to its anticipated direction, which is a buy. So if the market should retrace to that your order, is going to open a buy position. Now, don't forget that the market might not retrace. You might not get to that your pending order. So it's like a probability, but you should also be aware that for you to place a pending order there might be some things that you have seen that tells you that the market might retrace to that your pending order. So let's take for example, you are busy, you are doing something and you are not on your chart currently. You can decide to place a pending order, either a buy limit, a sell limit, a buy stop, or a sell stop order. So if the market should get to that place, to that price, when you are not available on your chart, a position is going to be open. A buy or a sell position is going to be open. So this pending order helps you as a trader to place a trade whether you are on your phone or you are not there. All you have to do is just to click the button and insert those figures, of which I'm going to be doing a video after this on how to sell, how to buy, how to set a pending order, telling your broker that take me to the trade either at this market price or you set a pending order. Lastly, I want us to talk about take profits and stop loss. So a take profit order is simply an order you send to your broker, informing your broker to take you out on a trade in profit. Now, let's take for example, you place a buy position. Now, don't forget that we are trading the direction of the market. So let's say you place a trade somewhere around here for a buy and the market is going up. Now, how do you close this trade? There are various ways to close this trade. It's either you close it manually with your hands, or you set a take profit level or a take profit price, where if the market should reach that price, the trade is going to close automatically, whether you are there or not. For example, we place a trade here to buy. We are buying here, somewhere around here, and we set our take profit here. Now, if the market should get to this level, it's going to take us out of the trade, is going to close, take us out of the trade in profit. Now, it's called take profit because it takes you out in profit. It means that you are going to be in profit because the market went to your anticipated direction. It went to your anticipated direction, so it's going to take you out in profit. Now, setting a take profit target is very important, especially if you are busy or you want to do something. For example, you place a trade and you want to go somewhere to do something, or you want to just get something, and you know that you're not going to be on your chart. So what you do is that you simply place this take profit targets. So you are informing your broker that if the market should get to this point, take me out in profit. Now, if you are buying a currency, your take profit has to be up. Why? If you are selling, your take profit has to be down, right? It's easy as that. Now, let's say, for example, you are selling, let's say you sold somewhere around here, you are selling a currency. Now, you set your take profit somewhere around here. It means that what you are telling your broker that if price should get to this level, close this trade for me in profit. Whether I'm there or not, just close it for me in profit. And how do you know that this place should be your take profit? Based on your market analysis. So if you are buying a currency pair, your take profit has to be up, and if you are selling, your take profit has to be down. Why? Because if you are buying, you are anticipating that the price is going to what? Appreciate or move up. So if the market should go to your direction, then for you to take profit, your take profit has to be up. And if you are selling, it means you are anticipating a decrease in price. So your take profit has to be down. Your take profit is always in your market direction. So if you are buying, your take profit has to be in your market direction. So you are going to get a reward forward for anticipating that particular move and at that time. So that is that for take profit. Now, stop loss is also an order that you send to your broker, telling your broker that take me out in losses. Now, stop loss is very, very important. If you place a trade, you might not necessarily set a take profit target, but stop loss is very important. Why? Because one, stop loss protects your capital as a trader. So if I'm placing a trade and let's say I want to lose, I've decided to risk $5 on that trade to make about, let's say, $10, right? Now, I can set my stop loss in a way that if the market should go against my anticipated direction or against my way, I will lose only $5 instead of losing my entire account. So I might have about, let's say, $100 in my account, but in a particular trade, I want to lose just $5. So after placing or clicking the buy or sell button, the second thing I have to do is to, one, set my stop loss level. Is very, very important, more than even a take profit. Why? Because a stop loss simply what protects your capital. Should in case something happens and the market goes against you, and don't forget that we cannot control the market. So let's say, for example, you are buying a currency, you are buying a currency pair. Let's say you bought somewhere around here. Let's say somewhere around here. You bought this currency pair here. Now, where should your take profit be? Up, right? Meaning what? You are anticipating that the market is going to what? Go up. So your take profit has to be up, while your stop loss has to be against your direction. This stop loss is protecting your account, that should in case the market goes against you, you are only going to lose a calculated amount of money. A calculated amount of money. So I potentially know how much I'll lose on a particular trade based on how much I've decided to lose on that trade because of my stop loss. So placing my stop loss here, I know that if the market should go down and hit this my stop loss level, the market is going to, the broker is going to close that trade for me automatically, whether I'm there or not, and I'll come back to meet my losses that I have calculated. So in forex trading, you get to place a trade. Once you place a trade, the first thing you have to do is to calculate your losses, your risk capital before placing that particular trade. So if you are placing a trade, you have, let's say, about $1,000 on your account. You might decide to risk about $50 or 25 based on your risk appetite on that particular trade, and your stop loss has to reflect that amount. So if something happens and you are buying a particular currency pair and the market goes against you, and instead of buying, the market ends up selling, and the market goes against you and hits that particular price or that level, you are going to lose just that amount of money that you have calculated and you have decided to lose or to risk, right? So stop loss is very important. And if you are buying, your stop loss has to be down, which is against your direction, while your take profit has to be up. And if you are selling, your stop loss has to be up, which is against your direction of the market, while your take profit has to be down, which is reflecting your direction. So stop loss is very, very, very important. Before you place a trade, the first thing you need to do is to calculate your risk capital. Now, that risk capital will help you, to know the amount of money that you are going to lose should in case the market goes against your direction. So and if you place a trade to sell a particular currency, if you place a trade to sell a particular currency, let's say the market is doing something like this, and you place a trade to sell here. Now, selling, you're anticipating that this price will go down, right? And you might set your take profit here and your stop loss here. Now, if this your stop loss, you have calculated that you are risking just $5 on this trade, it means that your take profit should be at least $10, meaning you are risking one to get potentially two. That's risk management in trading. Now, if you have calculated your risk and it's $5, now if the market ends up not going in your direction, which is not selling to hit your take profit for you to make money, something happens and the market ends up buying instead or going against your direction. Once it hits this your stop loss price, the trade is going to close automatically, and you are going to lose $5, which is the money you calculated before placing the trade. You have calculated that money, that this is the money that I want to risk on this trade. You get? So we cannot control the market, but we can control how much we lost on a trade based on setting our stop loss and knowing how much capital we want to risk on a particular trade. So setting a stop loss order is very, very important. If you are watching this video and you are asking yourself, now how do I set this stop loss order, this take profit order? How do I buy? How do I set pending order? How do I sell a particular currency? After this video, my next video, I'm going to be dropping how to set a stop loss order, how to set a take profit, how to buy a currency, how to sell a currency, and also how to set these pending orders on your MetaTrader 4 or MetaTrader 5. So thanks for watching this video. See you in the next video. Don't forget to like and follow me. Also share this video. Thank you very much. See you in the next video.